why we're getting so much volatility in the liability, because we're not resetting those two things. The issue here now, you might be able, you don't really need convexity. Well, I guess you do. You really do need both of these numbers every year. So yeah, if you really get it accurate, you'd have to do that. If y'all wanted to get together and break it up and then share the file, that would be all right. So yeah, it'd probably take you 30 minutes to do that. You'd have to just bring in the numbers. The way I would do it is I would bring in the interest rates, wherever they are. I can never find what I'm looking for in this file. You could probably just use the 10-year Treasury. Bring that in. And I would just do you have to divide by 100. So there's your interest rates. So I would just, you'd have to give yourself some room, maybe give yourself some columns. I don't know why these columns are so narrow. So yeah, you'd have to go there's one, do the next one. Boy, why can't I see that? What is that, 13, 14? And you do the next one. There's probably a button that does it. So you just have to do each one.
Do Alt HVT.
What?
Alt HVT. It should say Alt is saying and then home and then paste and then T is transposed.
Yeah, I'm not getting, it's not, I may not have anything.
That's a fast way to do it once you figure it out.
Yeah, if you can find a fast way to do it. That would be far more, you'll probably get far better answers if you do that, because you can see how duration is very sensitive to interest rates. Which means if you do what I did at the starting point, you would have been, your duration of your swap would have been really off when you started in the 70s because interest rates were so high. So that's the more accurate way to do it. But anyway, if one of y'all does it, you might share it with the other two. If you don't, just realize you can get more noise than the true answer. But if you get the duration and liability of your intermediate term bonds and a duration and convexity, duration and convexity of intermediate term bonds, duration and convexity of your liability, then you're going to have a much more accurate picture. And then when you're calculating the returns of your bonds, you'll use this formula instead of the numbers I had on top. And when you're calculating your dollar duration gap, you'll use these numbers, and you'll have a much more accurate. And I think that's going to bring your volatility down tremendously because it's going to be much more accurate. But yeah, if you did this, I don't know why it's green like that. That just doesn't make sense to me. So that makes it so hard to read. I cannot see what number it is, but you'd have to do each one down. I'm in the wrong file too. So you don't want the file for your pension liability. You want the file, well, I mean, actually you do. Here's your pension liability, so you do want to do it there. And then you want to do the same thing when you do your intermediate term bonds over here. Use interest rates. So you know, kind of figure out your strategy. It can take you a little bit of time to get that accurate if you want to get that accurate. If you don't get that accurate, then you're going to have a model that's not going to give you quite the answers that you want. It's going to be somewhat skewed. The other thing you could do is, if you want to shortcut it, then divide interest rates into, say, maybe 10 groups. 0 to 3, 3 to 6, 6 to 9, and just do those groups, and then use a lookup function or something just to get you the right duration convexity if you're in that range, so at least you're more in the ballpark. So when interest rates are between 16 and 19, you use a duration of 7 and whatever. If they're between 6 and 9, you use this one. So that way you only have to run like 6 or 7 scenarios instead of having to run it every single year. So that might be pretty accurate too. So let's see how sensitive it is. Here's on your liabilities. So you start 3%. There's your number for 3%. Try 6. Yeah, it's pretty radical at 6. You have to go 2% increments. And then 7. You might be able to write some formula that would get you pretty close. And so on and so forth. And then you can just say 3% or lower, do that. Between 3 and 5, do that. Between 3 and 7, use that. And that way, you don't have as many numbers. Now, if you do intermediate term bonds and long-term bonds and your liability and your swap, you got to do all of those. You know, the more you have, the more you have to do this. So that means this table may actually be not a bad way to do it. You're getting a lot of the numbers there, and so yeah. So maybe that's the way to go. Test that. So that's the biggest problem we have right now with this model, is that we're not reflecting the fact that duration and convexity are changing really dramatically as interest rate environment changes. All right, so that's it. I've never done this before, but I know it'll work. You can already see, even just doing that you've got some pretty interesting results. You know, can you really lose 55% of your net worth in 1 year? I'm surprised it's not 100% in some years, but probably what's going on here is that the surplus is getting so large on the stock side because stocks did nothing but go up in the 80s and 90s. So what funds actually did is they just stopped funding their pension plan because their stocks were up so much, and then the 2008 crisis hit and they lost it all. But they just stopped giving money to your pension plan. So, all right, let me save that.